Good afternoon, everyone, to our attendees. Look forward to spending a few minutes with you talking about the current market outlook for the beef cattle industry and how we look at what's going on and how that might relate to some price risk management tools that we can utilize as we really enter an exciting time in the cattle industry with much stronger prices. But as we've seen over the last several months, quite a bit of volatility has occurred as well. I first want to just highlight these are USDA's estimates of cattle and calf cash receipts. They just released these estimates last week. And why I highlight this is just to note the value of the cattle that we marketed in 2023 and 2024 are at some of the highest levels we've ever seen. And this is even accounting for inflation and looking at the value in 2024 dollars. Now, this takes into consideration both the price of cattle as well as the quantity or number of head that are being marketed. Now, we know that supplies are tightening, those cattle numbers are tightening, and that relates to maybe a little bit of what 2024 forecasts are for USDA is we're expecting stronger prices, but lower numbers being marketed. So maybe slightly lower receipts for producers. But again, as we look at forecasts, there's a whole year to be realized and the risk of prices changing throughout the year. Now, as we look at some price forecasts, here I'll provide some forecasts for feeder cattle, and I provide a bit of a composite forecast. So I'll utilize forecasts from the Livestock Market Information Center, from USDA's Economic Research Service, and then using futures prices and adjusted for an Iowa basis. And you'll see the gray column there, that's 500 to 600 pounds. LMIC provides those forecasts. And then the three white columns there are for feeder cattle. So consider that about 700 to 800 pound feeders. They're for different regions. The Southern Plains would be LMIC. USDA is an Oklahoma City price. And then the futures adjusted for basis are an Iowa price. First, looking back a bit, as we look at 2023, we had a price of about $222 per hundredweight for 7-weight feeders. This blew by the previous record of 2014 and 15, which seen $211 as an annual average price for 7-weight feeders here in Iowa. So those prices were roughly 30% higher than we experienced in 2022. And this even came after we seen the significant softening of prices in the fourth quarter of 2023. Now, as we look at 2024, expectations are higher prices, but I think there's a bit of variability of how much higher those prices will appreciate throughout the year. And that's really shown in the forecast here, varying from LMIC to USDA to the futures-based forecast. Some of that is a bit of timing. The futures-based, I pulled those futures prices as of yesterday. So that provides a little bit more up-to-date pricing, whereas we look at USDA will be updating their forecast here next week, which I expect them to strengthen those forecasts given what we've experienced over the last month since they've made those forecasts. Then as you get into 2025, I think LMIC is putting their neck out a bit and putting forecasts out that far, and they show further strengthening in both those calf and feeder cattle prices, with calves eclipsing $3 per pound for 5-weight calves and feeders up in that $280 range as we look at 7-weight calves. The fed cattle market is much of the same, where we've seen 2023 prices broke a record. The previous record was 156 in 2014. And again, this is even after softer prices than what we expected in the fourth quarter of 2023. 2024, there's quite a bit of variability, I would say, there about expectations of prices. Again, looking at LMIC as an annual average price of $193, they're showing prices continue to strengthen throughout 2024, with the highest prices being realized in the fourth quarter and above $200 per hundredweight. Now, futures-based prices, they're showing a bit more of the seasonality. The highest prices will be experienced in this spring at $188 as an average, and then softening a bit into the summer and then staying steady throughout the fall and the winter. Regardless, though, those forecasts suggest another record price here in 2024, roughly maybe 5% higher, and then continued appreciation of prices into 2025. Another way to look at forecasts, and I think this is really important when we think about the fed cattle market situation and packer capacity utilization. So as we continue to tighten fed cattle supplies and addition of packing capacity and expectations of packing capacity to come online in the coming years, that could really change the trajectory of when we look at capacity utilization. And so if you look at capacity utilization to impact on cattle prices, historically, there's about a 1% decline in utilization causes roughly a 1.32% increase in cattle prices. So if we use that and replay the situation in 2014 and 15, where we've seen capacity utilization levels really dip down below 90%, and we're in the upper 80 average for the year, but even throughout parts of the year dip below 85% utilization. We replay that situation, that would say a 189 average in 2024 with a variation of 171, which would be kind of current prices or what we experienced in parts of January, and see strongest prices of maybe 198, so almost $2 per pound for 2024. Then as we look into 2025 and replay that 2015, which was the tightest cattle supplies and lowest utilization rates, that gets us a range of 175 to over $200 per hundredweight and a 194 average. So I think that's really consistent with where some of those other forecasts are, but also provides a very optimistic forecast for fed cattle prices continuing to strengthen here over the next couple of years. And this is really due, when we look at it from a supply standpoint, we are in the downturn of that cattle inventory cycle. We just started the 10th year here as we look at January 1 inventories, and expectations are we'll see at least another downturn as we get into 2025 before we maybe start to see some expansion and start to build inventories from there. So overall, this is likely going to be a longer cattle inventory cycle, at least compared to the last cycle. It could be in that more range of 11 to 12 years potentially. Now, just how tight are our supplies going to be? Here's the balance sheet from the Livestock Market Information Center. And if we focus in on 2024, their slaughter levels are expected to decline roughly 6.6% for the year, with the strongest decline in the fourth quarter of the year. And then now add on to that in 2025, even another 5.5% decline. Now, production may not decline quite as much because we're potential to see a bit heavier weights. At least what LMIC is forecasting here for 2024 is maybe a 1.5% increase in those weights. But overall production, is going to continue to decline, showing those rather tight supplies of cattle that we're witnessing. Now, as we talk about expansion and when we'll start to maybe see rebuilding of the cow herd and rebuilding of feeder cattle supplies and eventually fed cattle supplies, we have to go back to profitability for cow-calf producers. So 2023 is the first year that they've really realized some profitability. If we look back over the last couple of years, 2022 was roughly break even. 2023, here the forecast is $244 per head. That's a lot predicated on cost and when I marketed those calves, right? Because remember, we've seen some of the strongest prices September, October, and if I had marketed those calves earlier, we're realizing much higher revenue than as we looked at October, November, and December, where we've seen that swoon in market prices. Now, 2024 is looking like a rather profitable year, roughly $500 per head, looking at this measurement of profitability, and that rivals the highest levels we've seen back in 2014. So that'll really start to trigger some of that expansion. And then looking at 2025 could be even a bit stronger than that. But so far, expansion has not started. So we got a recent cattle inventory report that showed that the number of replacement heifers were lower than a year ago. That matches up with the cattle on feed data that we get quarterly that shows the percent of heifers on feed. So roughly 40% of the cattle on feed in 1,000 plus head capacity feedlots are heifers right now. And you can see how that compares historically. So it's at the highest levels we've seen since really going back to October of 2001. And you'll note that in periods of expansion, like going 2014 into 15 and 16, it gets down to less than 32% in that range. So there's quite a ways to go yet, and shown that we're not seeing producers retain those heifers quite yet for replacement. And so that puts off expansion further because we're not seeing those replacements enter the cow herd quite yet. And then also, if you look at, we're not retaining more heifers, we continue to cull beef cows at really an accelerated rate. Yes, beef cow slaughter numbers are lower in 2023 than they were in 2022. Similarly, through the first 4 weeks, we're about 18, 19% lower in beef cow slaughter, but we have a much smaller cow herd. So you have to look at culling rates, and 2022 was the highest culling rate we ever seen. When you look at nationally back to 1986, 2023 was not that much lower. So we culled 12.2% of the national herd. And so far, our culling rate remains relatively accelerated, suggesting, again, we're still in that liquidation phase of this current cattle inventory cycle. Now, from a cost standpoint and resource availability and drought in much of the U.S., that explains a lot of the accelerated culling and lack of heifer retention. But also you have to look at cull cow values. So cull cow values remain historically strong and are really going to strengthen here as we get into the next several months and look like the seasonality will really bring those prices relatively strong. So that provides a lot of incentive for cow-calf producers to cull cows at these really strong values. Now, as we transition and look at the makeup of the feeder cattle supplies and fed cattle inventories, the recent cattle on feed reports have been relatively bearish. If you look at the headline numbers, especially looking at the number of cattle on feed. So January 1 cattle on feed numbers were up over 2% compared to a year ago levels. But you have to really dig into the data a little bit more to show you that we've really aggressively placed feeder cattle. We pulled a lot of feeder cattle ahead. We've had some delays in marketings at times, and that's provided larger cattle on feed inventories compared to year ago levels. But you can only place those cattle once, right? And so I think while February will show slightly larger cattle on feed numbers, we'll start to really see the situation of those tightening supplies play out over the next several months. Because we look at the makeup of these feeder cattle supplies, so you may say, well, another bearish factor is cattle on feed over 120 days is up 12% compared to a year ago. Over 90 days is up 9.5% compared to a year ago. But again, if you're placing those cattle sooner at lighter weights, by definition, they're going to be on feed longer. And so I think that's the situation here. It's not so much that we've delayed marketings and we're seeing those fed cattle supplies build up. One big indication of that is fed cattle weights remain relatively light. So this is the Iowa, Minnesota data here, live equivalent weights. So this is dressed weights and live weights. Dressed are adjusted to live. And it shows here that those weights are lighter than last year. They're lighter than we've seen in 2021, very similar to the weights we've seen in 2022. And seasonally, we're going to continue to see those weights decline here over the next several months as we get into the summer. Now, if you look at what's behind those cattle on feed, so I said the cattle on feed numbers are up compared to a year ago, but when you look at the feeder cattle supplies, so these are intended to be placed into feedlots, but they're not placed into feedlots quite yet. Those supplies are tighter than the tightest point we've seen back in 2015 for this quarter. So I compare January 1, 2024 to January 1 of 2015, and there we're seeing those feeder cattle supplies tighter. So if we expect further contraction in the cow herd, at least through this year, right, and we expect those calf crops to tighten up this year and into next year, that's going to give us much tighter feeder cattle supplies and be very bullish for prices going forward. Now we know we have very expensive placement costs for feedlots, and we also are at relatively heightened cost of gains. So if you compare cost of gains to 2020, cost of gain is over a 50% increase using the Iowa State model here for estimated returns. We had a 2023 value feedlot cost of gain of 126. The 124 forecast is for lower cost of gains, roughly 12% lower. But I think it's important to understand the makeups of these costs and these cost changes, because you'll see here that even at 2024 values, those are close to the heights we've seen back in 2013, 2012, when we've seen between 110 and 114. We had much higher grain prices back then that were driving those higher cost of gains. As we look at 2024, we've seen that feed grains have come down from 2022 to 2023 almost 30%. Now, complete feeds, concentrates, forages, all of those have shown, relatively sticky prices. Feed supplements have increased notably. But as you look at all the other costs that possibly go into finishing cattle, those costs have by and large increased year over year from 2022 to 2023 and are rather sticky prices. So those elevated costs are here to stay, which are contributing to those elevated cost of gains that are, yes, reflecting lower feed prices, but also reflecting these other prices that remain at historical highs. Part of that is interest rates. So we're seeing the highest feeder cattle loan interest rates since 2007, the second quarter then. And expectations are that, we're going to continue to see these interest rates relatively hold. I think there's some expectation that they will start to retreat at some point. But so far, we've seen Federal Reserve hold interest rates where they're at to help curb inflation. And that's going to contribute to these higher borrowing costs that we haven't really experienced, as you look back for almost 20 years. And so this has really changed a bit of the calculus when you think about cattle feeding and the interest costs that are contributing to those costs of gains. Now, as you look at expectations going forward, I'm going to highlight a survey out of Purdue University, the Purdue Center of Commercial Agriculture. Each month, they ask a random sample of producers that they survey. These are both crop and livestock producers. They ask them about what's your biggest concerns for your farming operation going forward. I think interestingly here, it really shows that the biggest concerns are what we've highlighted so far, right? Higher input costs, even realizing that some of those input costs have come down, like fuel, like fertilizer, like some feed cost components have come down. But overall, that remains the highest concern. Interest rates also remain, an elevated concern to producers, both for crop and livestock operations. So as we look at cattle feeding returns in 2023, those were some of the highest returns we've seen for cattle producers in a long time. It's actually, I think, in my series, the fourth highest annual average for cattle feeding returns was in 2023. But you'll note a return to possible red ink as we get into 2024 from an annual average about $90 per head loss, with some profitability in maybe April, May, and June. So as we think about managing price risk, I want to dive a little bit deeper into this data as I look at the Iowa State model for finishing yearling steers. And so I know I'm throwing a lot of data at you here, and hopefully you'll have a chance to go back and maybe review some of this as you look at some of the specific numbers. But here is several columns of looking when I placed those feeders, when I closed them out, the net return, the feed cost of gain, fed cattle price, feeder cattle price, and then break evens on those. And so highlighting a few numbers here as we look at the September closeouts right now, the forecast as of mid-month are losing about $200 per head. And you'll note here that the current fed cattle price forecast is about 182 per hundredweight, a break even price needed of 197.52. And that's driven by what? Higher feeder cattle placements back in September, right here the average is 259, and relatively high feed cost of gain at 113.62 is driving that needed relatively high fed cattle break-even price. But as we go throughout the next couple of months, and especially get into April, May, and June, you'll note there's some opportunity to lock in profitable prices and returns for producers, especially as you look at that May, which was equated to December placements, over $200 per head profits potentially, given what futures markets are currently suggesting. Now, why I note that rather strong profit here is if you look over the last 10 years, there's roughly about a 12.5% probability that we see returns over $200 per head in cattle finishing. So identifying there that's a relatively strong and profitable level that doesn't come around all that often, again, is another reason and another indication that that's an opportunity to offset a lot of price risk because we haven't realized those prices yet, and do something in the market, be it several available strategies here to put a floor on current prices, to hedge current prices, but allow maybe some upside, and we'll walk through some of those options here in the next couple of slides. So this is a slide I like to kind of quickly walk through to really show some of the strategies you may use given the expectations in the market. And we'll go over the price outlook here shortly. So, to give you a few examples, if you have a very certain price outlook and you expect prices to go higher, the best strategy is to stay in the cash market. And I would suggest a lot of last year was that strategy where we continue to see stronger prices week after week. And that really told us to stay in the cash market. Right now, unfortunately, there was a big change in the outlook as we got into the fourth quarter. And that changed what I should potentially have done given where prices headed. And there was, I think, some opportunity to offset some of that risk had I had some forewarning. We'll talk a little bit about that forewarning. Now, if I am pretty certain that prices are going to go lower, but I have an expected basis of higher, I may sell some futures. Now, a lot of times, price outlook, as good as we think we can do or try to do, we're still kind of uncertain on that outlook. But if you have a high implied volatility, you may look at something like synthetic puts or buying LGM. A lower volatility, you may look at put options or buying LRP. So keep this in the back of your mind as we kind of walk through the next several slides of what that price outlook is and where we may identify some strategies to undertake. This is a market price curve that I'll just highlight to give you a sense of where we need to really think about price risk management. We have to do it really before prices turn against us in not a favorable market. And so if you think about, when prices are on the upswing, there's a lot of optimism, excitement, thrill, euphoria, but at some of those market highs, a bit of complacency because you think prices are going to go higher. And then when you take a bit of a market dip, you may think, well, there's a little anxiety, but we'll see a rebound. And then there's denial, fear, panic, anger. And at that level, at a market bottom, there's very little you can do from a price risk management standpoint. Because if you would hedge at those levels, you would be potentially locking in a market low, unless you think prices will go down further. Now, as prices rebound, we start that path all over again with some hope, relief, and optimism. And you could conceivably lay that chart of emojis I just showed you over what we experienced in live cattle prices over the last year or so. And so this is April 2024 live cattle. If you dip back to last year, spring of this time, we've seen prices really start to accelerate. And they continue to increase week after week with a few maybe a few weeks that prices stabilized or dipped back a little bit. But overall, that trend was increasing into mid-September. And a lot of the indication was prices were going to continue to strengthen. The fundamentals were very strong in the market. But then as we got into late September, early October, prices really started to dip down and then slid from mid-October to early December. Now, looking back, hindsight's 2020, as the saying goes, there was some signals in the market that we were due to decline. And I looked at some moving averages here. If you want more information, you can check out an article on Wallace's Farmer that talks about using some of the technicals. There was a sell signal mid-October that said I should have hedged. April live cattle futures. We've seen the short-term moving averages 9 and 18 both cross the 40. Now, again, I said hindsight's 2020. If you're sitting there in early October, you're still thinking prices are going to continue to go stronger. So it may have been kind of difficult to hedge or buy a put option there because you would be effectively potentially leaving some money on the table. Although you would have been hitting your price risk management objective of locking in a rather profitable price at the time. Now, as we look at fast forward here and get into January, there's been a buy signal here in early January, and you've seen prices continue to increase. The real question is, where are prices going forward? So you could suggest there's maybe a resistance here at 87 to 88 price level, and that's why we've taken a bit of a step back. The relative strength index is right now between 70 and 30, so I wouldn't suggest there's much evidence or a lot of evidence, compelling evidence that we're going to go much further lower, but you've noted that we have taken a step back over the last several days in April live cattle futures prices. There remains quite a bit of volatility in the marketplace comparing to a month ago. There is lower probability that prices will go higher. And there is a bit of a higher probability that prices could go a little bit lower here. But those are a little bit more certain when we look at those volatility smirks here. Now, again, I highlighted hindsight's 2020. If we look back at the net positions of live cattle futures, and you break those down by producers, users, swap dealers, managed money, and other reportables, we did see that on September 26th, that week ending, the managed money position was rather large, especially when you compare it to historically. And so we did see a big sell-off there as they liquidated those net long positions for the managed money. And that is part of what contributed there to that market slide. There was also some fundamentals. The larger cattle on feed numbers helped contribute to that. But again, I think one of the factors was this managed money. But now on the flip side of that, you see managed money levels relatively low compared to historically. So I think, again, if we get in a stronger buy pattern from the managed money, they go further long in that position. That could help support prices further going forward. This shows profitability back to 1968 for cattle feeders. So as I mentioned, on an annual basis, 2023 was the fourth highest return year. If you had hedged, you got a bit higher than your expected hedge price because basis was a bit higher. But overall, for much of the year, the best strategy was to stay in the cash market until that late September, early October when we've seen prices slide down. So far, the market hasn't offered much for locking in profitability except for a few months into the spring. Now, basis levels, we track it here at Iowa State. We have a table to do that. I'm tracking it weekly here. I'll highlight that basis levels are very close to last year's levels currently, as well as the Olympic 10-year average. And so that would be the black line and gray line here. I have a lot of expectations that we're going to continue to see that trend going forward. And note that we'll see some of the highest basis levels as we get into April and late May of this year. Now, if we see basis levels stronger, I think that's an indication that we'll see further appreciation in prices and a situation where cash will be leading futures and will push much of those forecasts higher that I showed you earlier in some of those slides. Now, so far, I've talked a lot about the supply situation and tightening supplies. I think it is important to talk about the demand situation. Demand remains relatively strong, and that's noted here as we look at boxed beef values are higher than a year ago levels. They remain much higher than the 5-year average levels. And so that's in part of the beef packer margin, right? When we look at beef packer margins, they're getting the wholesale boxed beef price, they're getting a byproduct or drop credit, and then we're subtracting off the fed cattle price. So what I'm doing here is tracking those gross margins and then also tracking net margins using an estimate of net or estimate of cost to get net margins. And the net margins here are in the orange. And you'll note there that those net margins are pretty close to break even for beef packers. Now, this is with relatively strong demand. And entering a period, you'll see the far right hand there, we've ticked above profitability in those net margins. We're likely to see demand get stronger here as we get into the spring and summer months where we see some of the strongest beef demand. And that should help support beef packer margins and help support fed cattle prices and feeder cattle prices throughout the system. And so I think when we think about the long-term outlook and how strong prices potentially could go here in 2024 and 2025, we have to really point to demand. And I think the last quarter of 2023 provided us a bit of an optimistic outlook. So we had 6 quarters of year-over-year decline in beef demand until we got to the fourth quarter of 2023, where we've seen beef demand up 6.5%. Now, per capita consumption was actually up a bit, even in a shrinking supply situation. So much of that was we've seen lower beef exports. More of that stayed on the domestic market, so that mitigated some of that impact on cattle supplies and beef production numbers. But what's really leading demand is beef prices. So real beef prices were up 6.5%. Nominally, they're almost up 10%. So what this shows is we've been able to push off those higher prices to consumers, and they've been willing and able to pay those higher prices. That's a very good situation for demand. The challenge is moving forward, will we be able to continue to push those higher prices off to consumers? Will they be willing and able to buy them? If they are, we'll continue to see strengthening and maybe even stronger strengthening of prices than some of the current forecasts suggest. So I'll end there. I'm happy to take any questions. I'll highlight several of the resources we have here at Iowa State that provide up-to-date information that I've showed you on many of these slides.
All right, thank you, Lee. I really appreciated that cycle of the market shown by the emojis chart. That was good. So really exciting time to be in the beef industry. Thank you for sharing with us today.